So hello everyone. How are you doing today? I had to improvise a little bit, got stuck in traffic in coming back from Atlanta, so I am upstairs in our house. Hopefully we won't have any interruptions with dogs or package deliveries or family members or those kind of things, but didn't have a choice. Had to get to the first place I could to host this next series of Stay on Retirement Track. I am pretty excited about it, just for the sake of this is one I get asked probably as much or more than any, discussing the investments part of your 401k plan or retirement savings. And because I'm asked a lot of it, I wanted to actually record this and host this video today after the latest election. So maybe we could talk about the markets a little bit more. But they're not reacting as well today with the results from yesterday. So we're a little off, but that's even better, at least for the conversation to explain why it's so important to pay attention to this part of your retirement planning. So it's episode 3, and as I've mentioned before, this is not just for employees of clients of ours that we have 401k plans with. This is for everybody. So feel free to share this link once the video is released, and it's on our YouTube channel, to friends, family, neighbors, anybody that you feel could get some benefit from learning more on this information that we put out. Happy to take any feedback that you have. The chat room is not open today. We won't have that open. All questions can be directed to me via email or phone number, or anybody on my team at the office. So if you do have something that you want to go over, more personal to you or your situation, obviously please let us know anything that you want to address on this presentation today as well. We're happy to talk to anybody at any time. So we will get started. And as always, our disclosure of who we are as a firm. You need to obviously know this, or we're required to provide this to you. I'm happy to answer questions about what this means in the future if you need to know more about that. So these are our serious topics. You've seen, if you've been on our other two videos that we've hosted the last couple of months, you know that we started with saving for retirement. What is it? And then we went into how do you know is enough's enough. And then we're on the appropriate investment strategy. And then we'll talk about next time risk, which ties into this one really well. So we won't go into risk heavy today as much. We will focus more on just investment strategy overall, what it is. And this is a little bit high level. So for those who are attending or will listen or watch this later, let me just go ahead and disclaim that there's not going to be a lot of really detailed information about what a certain investment is or how it's performing, particularly in the last year or so. It's not going to be about a certain strategy most people should consider. It's more about what this really is as a whole. So if you're looking for direct investment advice, we're not going to do that. You're going to reach out to us directly, one-on-one, or as a couple, and we can cover that in more detail so we can make sure that it's customized to you and not some cookie cutter answer, which we do not like to give to anybody. So look at basically these topics. All right. When we talk about investment strategy, I'm going to hang on this page for a minute. When we talk about investment strategy with anyone at all, we are going to cover these types of things. Before we talk about whether you should have a certain percentage in bonds or stocks or cash or any kind of alternative investments or those types of things, we're going to want to know this. I mean, these all play into not just retirement savings, these play into anything else that you are saving money for and investing money for. So we're going to find out what sources of income are you guaranteed in retirement years. You may have the opportunity to collect a pension. You may have the opportunity to collect Social Security. There may be something directly getting paid to you that's guaranteed in your retirement years. We're going to want to know that. I'll explain that in a second. We're going to want to know what your fixed and variable expenses are. So if you've ever heard me talk before, which maybe you have, I go deep into not necessarily budgeting, but understanding what expenses are in your daily life. So, where's money going? Well, it's flowing in from income, it's flowing out somewhere. So where's it flowing to? And which of those things, as I talked about in one of the other sessions we had before, where are those things, which of those things are going to carry forward into retirement years? We want to know that. Which are fixed, they have to be paid. Which are variable, fluctuate a little bit. What are those that are wants versus needs? Which of those may have an inflation rate tied to it a little bit more? That means a lot when we talk about how to invest your money and where your money, how much your money needs to grow a return, which then carries over to risk on our next conversation, to really build an investment strategy for you. What is your threshold for risk? What's your threshold for volatility? That will definitely be covered in the next session. But just to touch on it, there's plenty of times that people have come in and they'll say, "Hey, I need to have." They don't usually say X% return, but I need my money to do something more. I need it to grow at a certain level. I need to hit this number, they think. Or they may come in and say, well, my mother, or my father, my brother, my sister, my friend, my neighbor, they're investing this way. I want to do that too. They say that's really good. What we want to know is what's your tolerance. Okay. So why that's so important is because if you have a high tolerance for fluctuation or volatility, then as the market's doing what it's done this year and just kind of been all over the place, you're probably not going to react on it that much. Your pain level's not that bad. You don't have so you could take these punches and not worry about, oh, I'm nervous, I'm scared to death, I'm going to sell and go to cash, which probably is the worst time to do it when you want to do it because it just is when it finally gets the pace too high. So we will not put somebody in something that has a higher risk level if they're not risk tolerant. So we have to mix their or match their tolerance to the risk level that we put with them as an investment strategy. That is huge, particularly in 401k savings. The worst conversation I have with an employee of a company is they tell me, "Oh, I can't. I stopped saving it or stopped investing it 6 months ago. I got nervous and completely stopped putting money in my plan, or I got out of the investments I was in. I'm straight cash in my 401k." I implore people before you make those major decisions like that, when you're in a stress point, nervous of the markets in this example, talk to somebody who knows what who knows what they're doing uh, in the world of investment management. It could be a friend, it could be somebody else in the business, it could be us. If obviously you're 401k and you're a client of ours, please send us a message and say, I'm scared to death. This is what I'm thinking. What should I be doing? We're going to know your time horizon. You've seen this and heard this 1,000 times over. I'm sure if you've ever invested $1, is that how long can you let that money work for you? So if you're at a conversation today with somebody, they're short-term investor, less than 2 years, they need money for something. Well, I'm not going to put that in the stock market. There's no way in the world I'm going to risk their or put their money in any volatile situation if they're going to use it later because I can't guarantee any returns in the stock market. None of us can. If they tell me, "Hey, Chris, I'm saving for 10 years or 15 years or 20 years," oh, sure. I mean, and you have some tolerance for volatility. Absolutely. I mean, it may be something we ought to consider. We're going to need no more than that, though. But that may be now we're headed on that track of stock investing or risky asset investing or riskier asset investing. So, what's your experience is another one. The last thing we ever want to do, I tell people all the time, the beauty of a 401k plan, if you've never invested before, particularly younger employees, is that it is a great starting point to invest. It's a great starting point to learn because essentially one thing is that the menu of options that are in your 401k plan have been built by somebody and they're scrubbed often, they're researched often, it's made sure that you have the best of the best. If you're not a client of ours, I'm hoping whoever is working with your company's plan is doing that for you. But we do it for our clients. We make sure the investments in the plan are as good as they possibly could to keep people from making mistakes and buying bad stuff like you can if you just did on your own. Um, so it's a great experience to learn because one of that you have a good selection that we kind of cherry picked for you. It also has tools in your 401k plan, technology that you can use to help you determine what kind of things you ought to put your money into, and it has people like us involved with it that you can ask. So it's a great training wheels to start investing for sure if you've never done it before. But if you are an inexperienced investor, the last thing in the world somebody needs to do if they haven't experienced investments in the past and don't understand how investments go up and down regardless of what they are, that they need to all of a sudden the first thing they buy is the riskiest asset they could. The last thing in the world that somebody needs to put their money into, one of the last things, if they never experienced the markets before or volatility before, is things like alternative investments or Bitcoin or some kind of currency, international currency that can do that. The returns could be fantastic, but you've got to have a high tolerance. You got to have a high tolerance for pain, high tolerance for pain, because it's going to hurt in certain situations. And you got to have a long time horizon, and you got to be willing to say, "I'm sticking my hands in my pocket. I'm doing nothing. I'm going to watch it." And you also don't want to put your nest egg in things like that that potentially could lose it, a lot of it, or potentially sometimes all of it. So we're not going to, as advisors and consultants with 401k plans who help build your menu, we're not going to put things in your plan who's going to that are those, there's assets that fluctuate. We know that because you have them. But we're not going to put things in there that you're going to wake up tomorrow and they're going to be completely gone. We don't want things in your plan and give you those. We don't want to give you those tools or those or the ability to do those things. So we're going to manage away from that. The other thing we talk about what investment strategy is correct is what goals it attached to. We're talking about retirement now, so obviously it's these funds in your 401k are attached to your retirement account, which could be you may need those funds tomorrow. You may need those, tomorrow's hypothetical. You may need those funds this year, next year. It's getting close in a year. Next year for retirement, you may need those funds in 10 years. The one thing I continue to tell people, which what goals they attach to, comes with all the things above that line item on this slide. You've got to really understand you. You got to really understand what you want your money to do for you. You got to really understand when you're going to need it. You got to really understand what gap it has to fill, like your income. You're not going to have enough income, guaranteed income, so you're going to have it from somewhere to help cover the expenses that you're going to that you got to pay. And so the retirement plan should do some of that at that point. So we want to look at all these things in great detail. And I think people need to focus on those in great detail and understand what the purpose is. One thing as far as long-term investing in a 401k plan, remember this, and I have to tell this to people all the time, and this is your situation, not mine. So you got to understand you again. The money that you have saved in your 401k account, just because you retire from the company that you're working for or wherever you're working, that doesn't necessarily, in whatever age that is, I don't care if it's 60, 62, 70, but it doesn't mean you're going to, at that point, liquidate your 401k account, cash it all in, stick it in a checking account, and start spending it all. Nobody really does that. There are circumstances where somebody retires and they take a big distribution at retirement to pay off the house, or they take a big distribution to help a child with something, or make a major purchase. But rarely have I had experience in my 25 years that somebody had and working, and that's with thousands of people, with somebody saying, "Hey, I'm retiring next year, and when I retire, I'm cashing everything in and I'm using it." That's not what you do. You can leave it at the company in most cases that you retired from or you left. You may know people have done that. You can roll it over to an IRA. That's up to you. You need to weigh the pros and cons of doing both of those, and we can help you kind of weigh those pros and cons, of course. But usually, regardless of which one of those two choices you make, you're not still cashing it all in and spending it. So if somebody's 60 years old, potentially, this is not, if you're 60 years old and you retire at 65, that's only 5 years. That's not really long term, it's intermediate term. But when my conversation with you in that situation is like, okay, when are you going to start distributing the funds from that account? If you say, Chris, I'm probably good for another, I'm retired, I got Social Security, my wife or husband's still going to earn income and hasn't guaranteed income coming from somewhere else too. We may not really need to start using it based on our financial plan or our calculations until maybe 70, 72. Well, that's 10 plus years now. So we actually don't have to go from a allocation of stocks down to cash at retirement age, because you're still going to have to, if that makes sense. I'll talk about that in a second too, is how we start to move money and that's going to cover next week's too, or next month's too, when we talk about risk a little bit more, but how we will move money into different portfolios when the time comes that you need it. So that's a lot. I talk fast through those, but my purpose with it is to let you know it's not as simple as, hey, should I just have 20% of my money in bonds, 10% in cash, and 70% in stock? It depends on you completely. So managing your risk, again, touch on this the next time a lot, but if you look at this example here, a stock portfolio, 100% stock portfolio that's in the middle of this page, a 12-month average over 30 years, back in time, this was ending in 2018. So 2018 and 30 years prior to that, it was the average return was 9.97%, which is a really fantastic number. The risk level was 17.19%. What a risk level basically means, that's your pain point. So during that course of time, the full stock account, as you know, if you ever have one, is going to be volatile. There's going to be plenty of times it's in the negative. Plenty of times over those 30 years, it's in the deep negative. If that's going to be your philosophy and your strategy, it's worked in history. Doesn't mean it's going to work in the future. But you should have a tolerance for pain. You should be able to sit there and go, I don't need this money for a while. I'm sticking my hands in my pocket. If it's volatile, not worried about it. I still have another 25 years. I still have another 20 years. I still have another 15 years. Not going to be concerned. Um, but you have to have that tolerance and you can't make changes to it, or you may make changes at the worst possible time. And if you make changes at the worst possible time, you're not getting those returns back. So you basically at that point have cashed in your chips and you're not making that, probably getting it back. And by the time you buy back into the market, it's already recovered some, and you hurt yourself now twice. An asset allocation portfolio is what I want to hit on a little bit more. We believe as a firm, and we do this with our clients, regardless what kind of accounts they have with us, that they need to have some type of portfolio built. And that portfolio may consist of these three asset classes, and it could be more, as stocks, bonds, and cash. Now, the percentages are based on all those things I went over a second ago. All those questions about when you're going to need money, how long, what's your risk tolerance, what's your time horizon, those kind of things. And it also changes what the market conditions are. So some years a client in their personal situation may need to be this exact 60-30-10. There may be some years the market's adjusted a little bit differently. It may need to adjust if, 50-40-10. And so it can swing a little, and that's where people like us can give you a little bit of advice on that. If somebody has this type of portfolio of that same 30-year time period, you can see the return is less. It's less by over 1.5%, right? So it's 8.37% on average, which is less, still fantastic number. What really helps on this one though is that risk level. You can see how much lower that risk level is by having a diversified portfolio. Your return over time is less, yes, but your stress is less too over that time, and you're less likely to make a bad decision going, oh, this was a terrible year. 2008, I'm selling everything in my full stock portfolio. This may have been able to stomach it better. And I promise you, those type of people, even though these numbers give that, probably had a better overall return because they didn't make decisions on making transactions against their account. So that is huge to know where your allocation should be. And it's a little different for everybody. So you need to pay attention to that. There's a lot of portfolios that are built into to clients' 401k plans, whether they're in target date funds or whether they're in asset allocation funds or whether they're in portfolios that Howland Trust manages in your plans. But you got to know where you stand a little bit. So it's about you. Then it's about selecting a portfolio that matches you. Okay. And feel free to ask us those types of questions. All right. On the next slide, real quick. So I just want to give an example for people who talk about historicals. If you would have invested $10,000 in any of these situations since in period of time, again, the Great Depression, which now was a long time ago. I mean, we're approaching 100 years almost in the Great Depression, but the Great Depression, since Black Monday, since the dot-com bubble, the Great Recession, or since COVID pandemic, if you had stocks versus bonds versus a balanced account, which is that last slide I told you, an overall portfolio of stocks, bonds, cash. These are the performance. These are where a $10,000 investment would have come into had you never touched it, had you never done a thing. If you just left it alone, could stomach the pain. None of us are probably still alive if we put the money in the Great Depression, though. Some of us may be, but that's pushing it. But these are where the numbers would have been. The point is to show that if you take things with higher risk over a longer period of times, yes, they 100% can give you more. But you got to understand too, there's also alternatives to that. And we need to find what matches you, because there's no way I would believe if somebody put $10,000 in the market since the Great Depression, it would still be sitting there. They would have done something with it, whether take the gains out and spend it, whether reinvest it in something else, whether got scared to death. There are all the different things from wars to recessions to depression, almost a depression, to other things that have happened. They would have sold out of that thing. So it's hard for me to believe they would have still sat there and done that. A balanced approach, even though it makes less money over time, possibly could have made you more money because you're less likely to react to it. And this goes into what a balanced approach looks like. So if you had, and this is called a bull nose chart, if you want to, it's called other things too. We've always called it a bull nose chart since I was in college. But if you look to the far kind of right upper quadrant there, you'll see the stock portfolio from 1970 to 2000, from 1970 to 2019, 100% stocks. Their average return it'd be the left axis, and then the bottom is your risk. So the higher the potential return, the higher the risk. That's what that shows, that full blue circle right there. As you start to move to your left, down to your left, you'll see it. We're adding in this a portfolio now. We're starting to add bonds to it. What bonds it does really is a buffer. It does pull away some of the return from a stock portfolio. However, what bonds do, or cash or some other types of fixed investments, what they do is they lessen that risk. So you can see as we move to the left, we're our return is lower, but so is our risk. It's about what can you stomach again as an investor, because you may not need the maximum return that a stock portfolio would give you. That may not even be at all what you need as far as your financial plan and whatever you're saving your money for retirement or anything else. You may easily can do any of these others or somewhere in the middle of any of these at those return levels and be perfectly happy and reduce your stress level of what is in. Here's an interesting point about a bull nose. So a bull nose chart shows at some point it hits a I don't know, a wall, let's say that, and it starts to bounce back to the right. 100% bond portfolio, as you can see in this, it's the same thing if it said 100% cash. We will actually see the return is lower, right? Because the return still goes lower. The risk picks up. What in the world will cause the risk to pick up on a stock or a cash portfolio? Interest rates and inflation. So if there are certain periods of time that stocks will be a buffer for a bond portfolio. Sounds crazy, but they are. So what we're looking for is the most efficient thing to put your money into to get you the maximum return that you need for what you're saving your money for, investing your money for, with the least amount of risk possible. That's what an investment strategy really is. It's about finding the most efficient portfolio investments for you as an individual based on everything we've already talked about. And that's not one of those. And I know some people are sitting there going, well, that doesn't tell me anything. What, I still don't know what to do. Ask. That's where you have to ask people. When we do education sessions, when we put out articles, when we do these types of things as webinars, listen, come in and hear what we got to talk, hear what we got to say, and ask questions. Contact us with questions. If there's a group of you in your company that your water cooler, cafeteria, break room talking to, going, I listened to Chris's presentation, it made no sense to me. Some things did, but I'm still confused. Talk to your manager and say, hey, there's 5 or 6 of us sitting here, and we really need more. We need more help understanding what in the world we're doing with a 401k plan. Can you call Chris or somebody on Chris's team and see if he can come over, see if he can schedule a personal webinar just for us? Maybe just a Q&A kind of webinar, not even a presentation by me. Happy to do it. That's what I want to do to make sure you guys are okay. One of the last things, or really the last thing I want to talk about, is dollar cost averaging. The beauty of a 401k plan, the absolute beauty of it, is if you are contributing, you're putting money into your account every single paycheck. If you're putting money into your account every single paycheck, it's also going into the investments that hopefully a nice investment portfolio strategy that every single paycheck. If you do not need if you do not need that account to be utilized for distributions anytime soon, like in the next number of years, a little volatility in your investments is not a bad thing at all. It's actually a pretty good thing. Explain that because it sounds crazy. You've got good investments in your account. We've already established that. What you have your money in are good. They're just volatile with what's going on in the economy and the markets, right? So you are buying now with the volatility shares in that investment strategy that you have that's good at a cheaper price. Let me repeat that again. You're buying good things on sale. My biggest example, and I did a video on this last year, if your favorite pair of shoes, if your favorite purse you wanted to buy, if the car that you always wanted, somehow the dealership or the store or whatever dropped the price of it, there's nothing wrong with it at all. It's just they just have extra ones on the car lot right now, and they just need to sell them, so they're dropping the price. Do you go to the dealership and go, must be something wrong with the car? I will never buy this car, even though I love it, I always want it, because you dropped the price. I'd rather you charge me full price at a discount. Absolutely not. There's no way you would do that, nor would I. This is an opportunity in a 401k because your dollar cost averaging, dollars are going in on an average over a period of time, every paycheck again. You're able to buy things on sale. So particularly if I'm 10 years, 15 years, 20 years plus of needing this money, oh my gosh, give me some volatility. That may not be good for the person who is a year away from using it, Hopefully, they've already reallocated a little bit to prepare for that. But for those of us who have a little longer time until the need arises, retirement or anything else to use that account, oh my gosh, you want this sale. You want you want the prices to drop some. You have good stuff that's been discounted because of what the economic global conditions are, and you're able to get a little bit cheaper. When it bounces back to its normal price and grows from that, you exponentially make more money. That's how people create wealth in their 401k plans. Please never, ever, ever stop contributing to your 401k when the market is volatile and when your account is volatile. I would even argue if you had a little extra money and you weren't using it for anything else, put more in there right then. That may not be the worst time in order to add some more. And when the shoes are on have discounted the shoe prices, don't buy one pair, buy two, buy a different color. Put a little more if you can. It works for you every single time. So having said all that, because that's a lot, that's a mouthful, you need us, reach out to us. Went a little longer today because I'm passionate about this part of this. Um, HighlandTrustPartners.com is our website. Our contact information is on there. Here's a global email address that goes to multiple people. Mine is Chris.Caldwell at HighlandTrustPartners.com. Basically, first and last name with a dot in the middle of every one of us. You can reach us that way for the most part. Call our office. If we can help you answer questions, do not be bashful. Please reach out to us. We want to be there for you. We want to make it where you have a successful retirement, which means we want your retirement plan to do what you need it to do to get there. All right. So with that, I'll be quiet and I'll sign off. Have a great rest of the day. And hopefully we'll be talking to some of you in the very near future. Thank you so much.